I want to put a disclaimer in here for you guys, just so you have the legal side of things out of the way. And again, obviously our room is for education. We don't call signals. We don't give advice. So we appreciate you guys being here. Today, I have a lot of questions, or have been asked a lot of questions, and will be asked a lot of questions. So I want to really focus on what this room is designed for more than anything else, which is making sure that you, as a new user, understand our software, what to do, when to do, and how to do it. So again, Eddie, we were talking about your trade setup here. And again, this is just one of those situations where when you look at the triggers on the big chart, you're like, oh, they're great. And then you look at the triggers on the 8-2 chart, and I agree with everything on all of your small charts. Unfortunately, it just went a little bit further. And again, this is one of those situations where you can look back at it and kind of second guess it a little bit and say, okay, because I hit resistance lines and 4 triggers didn't get through, I might go a little bit deeper. The other part, and again, the objective is to buy on the way down. So, again, the market flow is really, really, really helpful. Buying on the way down into the, and again, if you're going to use the market flow, again, you want to buy on the way down into the market flow area. So, again, just a little unfortunate you got bumped out of that before it went up. Anyway, hopefully you were able to pick up, some of the farther away stuff as we went forward. David, you were posting in. This is the results of your replay over the weekend. And again, just, correct me if I'm wrong, but you did 2 things. Number one, you were, tracking your results. And then number 2, you were going in and taking pictures of each of your trades. And one of the trades that we had talked about on Friday was kind of an exception to the rules, technically, where, again, you got in at a mid-band and fib right when it was changing colors with a strong trigger, which is not technically one of the trades, per the rules, but given the right situation, this trade right here works out a lot. Again, look, let me take a picture just so I can have some arrows, and here, hang on a second, watch. And again, I want to add a little bit to what you did there, David, because again, this trade that you were talking about right here, again, I'll highlight it with a bunch of arrows for myself. The little stab back, buying on the pullback right into the area with the very, very strong small triggers. This trade has to be prefaced with a major area or major top or bottom, getting hit. So again, I just, and again, when I tell you guys little nuances or little things, sometimes I worry that you try them too many times and you try them in too many places under the wrong conditions. So again, if you have major fibs on your big chart and you have multiple time frame fibs and divergences on your small chart, and you've already made a really solid bottom, then this trade right here, one time, is going to work a lot better. Yeah, so, I mean, look, that's what replay is for, so you can test out the thought process. And again, look, you tested it out, and here's your results for, for the replay week. Was that on 2 contracts, I'm assuming? Consistent all the way through? So again, look, if you can make $3,000 a week, which is $600 a day on the average, it's hard to argue, right? And again, the idea behind what we do is to do what? To take what's in the plan, right? So let me get the plan open here real quick. And again, to take the rules for like a trend trade or a counter trend trade, or any exception that you might find, and And not only, again, the objective always to keep in mind is to try to average over $400 per day per contract. If you can average over $400 per day per contract, then you can make a lot of money. We can all agree to that. We don't have to go through numbers. So when you look at your results for a week's worth of practice, you've averaged, $3,000 for the week, which is $600 a day. I mean, you're 50% over the average. So again, on a 2-lot, look, if you kept this consistent up, it's a lot of money. Anyway, needless to say, nice job on the practice. The more practice you do, the better you're going to get. The other thing too, and again, I want to highlight this because it's something that I think is very, very powerful. Eddie, I did make that little addition in there where added in the totals for the week. So again, this tracking sheet that all of you guys should be using, some type of tracking sheet. When you do practice, the objective or how to get better, so to speak, is simple for everybody. Learn the rules. When can you trade? When can you not trade? Simulate the rules during the day, post pictures in, ask questions, simplify it in your brain. Right? With Milby, we were talking about this. This is where you're at, trying to simplify in your brain what the trades are. Then go back and trade during the day, but then retrade that day or retrade the entire week and continue to practice and repeat until you guarantee yourself you can win. And then only when you guarantee yourself you're going to be a winner, which again, it's kind of a goofy thought because you have to guarantee yourself. And you're going to do it through trading live during the day on simulator. I should put sim live on there, right? So there's just no confusion. Simulator and then replay. And if you do this every day, sim and then replay and then take pictures of your trades and notes, and you do it day after day after day, number one, you're going to be able to see during the week, what did you make during the week on simulator? And then what did you make for the week on market replay on practice? Which goes back, David, to what you did. And, even the numbers are pretty close, right? You did a whole week's worth of replay and you ended up with, $6,500 during the week. Maybe during sim, you only made $3,000. So again, the objective for what we do is to try to close the gap between, what you see on the charts, what you understand with the plan, and then ultimately, how do you convert theory into making money, right? That's the most important part. How do you convert theory of going long when the triggers are up at fibs into making money? And, how do you convert looking at your charts and saying, I should absolutely be taking another long trade, which I'm sure you guys are in a long, right? Eddie, again, look, here we go. All right, so you were long and you went long and you got out a little bit early, took 11 ticks on it. Not a big deal. In a really strong trending look like this, Eddie, don't let the term weakening fool you. It's not weak, it's strong. And again, I understand what you did. You said, hey, I'll take some quick, easy money on that one. No big deal. Again, usually, Eddie, I like to run into something first, if this makes sense. I know you ran into some small triggers here, but, running into some type of resistance that might actually stop the market. So looking at my charts, look, here's resistance that might stop the market, or obviously fib resistance that might stop the market. So preferably, I would rather run into some type of either divergence high or fib resistance before taking money, and then you end up with usually a lot more money. Here, we'll take a look. So again, look, here's where you bought, and again, I like the idea of taking the money, but I like it a little bit more at something like this, like resistance. So again, still a good trade, still winning, just maybe not fully maximizing the total position, but hey, no big deal. There's 100 trades coming this week. So I want to go through one little statement. Milby, are you in yet? All right, good morning. I just wanted to check on you. And again, look, guys, I want you guys to ask questions. I don't want this to be a lecture. If you want to lecture, you can watch the videos. I want you to be able to ask questions. I want to discuss a concept that Milby and I were talking about. And, again, this concept stems from, hang on, click the wrong button here. The concept stems from Mark Douglas's book, and I worked with Mark Douglas for quite a while, way, way, way back in like 2001, 2002, maybe even 2003. And we had a long debate, and the debate was by Mark. He said most people don't really understand what it takes to become a successful trader. And I said, well, that might be true. I said, but everybody can be taught. And he said, I don't think everybody can be taught. And I said, well, if the rules are good enough and the software is good enough, and basically I was making a case for my software being so good that anybody could learn to use it. And again, this is a little excerpt from his book and some of my own personal, my writing is in dark, bold black underlined. So I took his portion of his book and I added my own comments to this. So just so you guys know what's mine in the dark highlighted and then what's his. And again, the whole theory of the psychology of trading, right? The difference between predicting something that will happen and thinking about all the money you could have made and the reality of actually doing it. There's a psychological gap. And I think everybody who's day traded in the past knows about the gap, right? You can go back and look at a chart and see all the money you're going to make, but it's not always as easy in real time to make that gap. And, to make that trade or to put your stop there, to be brave enough to take it. You guys know what I'm talking about, right? I'm 100% confident that I should do this trade no matter what. And that's really, I think, where everybody needs to get to with their trading is I don't care if I lose. I'm going to take it because my rules are met. That's the ultimate, if there is such thing as a holy grail, the confidence to take a trade regardless of the outcome, that's the holy grail. And again, I'm going to use it in the context of our software, of course, but the gap between what could be and what will be is only closed through practice and execution of a plan that is very rigid with very little ambiguity, but also flexible enough to account for the dynamic nature of the markets. This is the part that engineers have the hardest time with, right? In the type, anal retentive, perfectionist type people, because the market's never the same twice, ever. The people, and this is from Mark Douglas's book too, but bottom line is whoever was buying and selling that created the trend trade 3 weeks ago is not the same guy or firm or whatever that's making the trend trade this week. So the idea behind what we do is to have patterns that we trade regardless of who made the pattern. And the patterns start with the trigger lines. And again, this is something that's, it's flexible, but it's very rigid, right? The triggers, we never know what the triggers are going to do, right? Whether they're going to keep going, whether they're going to stop, whether they're going to reverse, whether they're not going to reverse. So the only thing that we can do is to understand the current state of the trigger lines and what we should be doing because of that. And again, you have to kind of have a mental aha moment here where you say, okay, it doesn't matter what the trigger lines are going to do. It doesn't matter what they did. It matters what's happening with them right now. So when we have this look, right now, we're able to determine what we should be doing with confidence. So again, all of our trades, I'm talking about trend trades first, of course. We'll talk about counter trend trades later, but all of our trades start with the same thing. They start with a look of our triggers. Everybody okay with that? And again, we talked a lot about this last week. We talk about the same thing pretty much every week, but again, there's no, we do the same thing every day over and over and over and over and over and over. So bear with me. Let me find the picture. Again, because we do the same thing so many times, I'll share the picture with you and we'll just look at it together. But this is a picture we made 2 weeks ago, 3 weeks ago. Who knows? We use it every week. The first thing that you're going to do for a proper trade is you're going to make sure that your trigger lines have the right look. This is the number one rule. You have to do this first. Eddie, this is why you had the trouble, because the 14-2 chart, you had the right look on your small charts, but you did the third thing first and not the first thing first. And this is where people get, a little bit messed up. If you don't have the right look on your big chart, you're going to have a harder time with the second or third thing. First things first, have the right look. If you don't have the right look, or if you do have the right look, but there's something that's going to hurt your trade. Have you guys traded automated systems before? Milby, I know you had this conversation about automated systems. The problem with automated systems is they only look at the third thing. They only look at a trigger line, fib, mid-band, indicator configuration, and then they generate a trade. Automated systems don't have the ability to distinguish the difference, the subtle difference between what's going to win and what's going to lose. So again, I want you to think about three components. First thing is your triggers have to be right. And again, it's going to be pretty easy, right? The triggers are going to look like the triggers, and we're not going to trick anybody with anything, and we're not making anything up new. Second is you have to make sure that your charts don't lower the probability of your trade winning, or you're going to end up losing. And again, this is the concept, Milby, that we were talking about, that again, it's one of the concepts that's a subtlety, but it's not really that difficult. So again, it's just like, I'll use the example. Eddie said that the chart is weakening right here, when most rational people would say this is not a weak looking chart at all. It's actually a strong chart. So the terminology that we use for weakening is that the small triggers are physically getting inside of the other triggers, but it's not really weak. It's just inside and strong up. And it'll be weak when we hit resistance, but it was already weakened when we hit resistance back here and it broke through. So again, the idea is where the trigger lines are located relative to a fib area, and if there's 4 of them past an area. So look, 4 triggers past resistance on the 14-2 chart is okay to take one more long. And Eddie, this is where you failed on your trade. You had resistance hit, which I'll draw a box on, but you did not have 4 triggers past the resistance. And it's not that we weren't going to go up. We're going up. The problem is, and I'll show you, watch, the subtlety. Milby, you'll understand this too, and Eddie, you'll see it immediately. Not 4 trigger lines past resistance. So we should not do a 5-1 trend trade. We're not saying So look, Eddie, again, look, I go back to Eddie's trade because Eddie, again, I'm sorry you're the victim of a loss, but it's the concept of having four triggers past a resistance area. And again, resistance for us, mid bands, fibs, or even a 165 EMA, but just call it a mid band. And again, when you're in the live world in a vacuum, you have to say to yourself, look, this is a resistance area. And again, I always do this with a black box because it's easier to kind of black out the whole thing. And, the visual, I think, becomes much easier with the black box. So look, this is resistance. And when you're about to do your 5-1 trend trade, how many trigger lines are past the resistance window? And the answer is 2, maybe. So let's just call it 2. And it's not that we'll never go up. The rules say, and again, I always like to refer back to the rules, but watch. The rules say, bear with me. And again, remember, this is the B section. The B section is the things that could hurt your trade. And it lowers the probability of a 5-1 trend trade. Doesn't mean that it will never go up, but if you can count 4 triggers beyond any fib or divergence or even mid-band on a big chart, you can keep taking trades in that direction. If you get to a mid-band or fibs or whatever, and you don't have 4 trigger lines beyond the area usually is going to cause more of a bounce. And again, sometimes you get 2 trigger lines past an area, but it reverses anyway. So the 4 trigger line rule is pretty powerful. Eddie, do you see what I'm saying about the 4 trigger lines? And again, it's not that it will never go up. It just means that it usually will pull back a little deeper. So again, on your trade, it's not that you're not going to go up because fibs and there's lots of good stuff, but it just went a little deeper than the 5-1 trend trade. And when you take the 5-1 trend trade, you lose, but the damn thing goes up anyway without you, which is frustrating. And again, it's not written out, on your chart for you like this with the explanation, but when you look at, and again, I don't mean to beat up on your trade, 100% all of your small chart reading was perfect. But the problem with your trade was the 14-2 chart said you're going to go deeper. So again, look, not 4 past. We will still go up, but from a lower spot. How's that? That's kind of the look. And again, this is one of those things that, it's a hard, fast rule, but it's also very, very, it's a, so look, I was doing it in the context of this. It's a very rigid rule with very little ambiguity, but our software in the current situation is flexible enough to account for the truly unique and dynamic nature of the markets. This statement that I wrote in here, because the markets truly are unique and they truly are dynamic. And that's where the people who first get our software, and Milby, I think you're in this situation. I don't mean to call your name in a bad way, of course, but I think this is where you're like, okay, I'm trying to work through the flexibility and the ambiguity, or a little ambiguity, but a little bit, but what do I do and when do I do it? And, these are the things that we go through. Now, one more thing just from this, and then we'll get rid of this darn thing. Traders that are winners focus on the information that helps them spot the winners. They don't focus on stuff that scares them or focus on stuff that doesn't fit their plan. So if it doesn't fit your plan, they don't even look at it. They don't worry about it. They don't think about it. It doesn't scare them. And again, the thought process is, what are you going to do? When are you going to do it? Again, you did a 5-1 trend trade when the large chart said don't. and it went up, but it went up from a lower spot, which is the frustrating part as a newer user, because you're like, man, mother scratcher, I knew it was going up. I mean, you knew it. 100% you knew it. And you end up getting bumped out trying to buy the 5-1 chart when you should have bought the 14-2 chart area. Anyway, just, and then look, the same rule, just to kind of, keep going with the rule. Look, 4 triggers past resistance. That's a pretty hard, fast rule, don't you think? I mean, when you get resistance and you say, okay, let me use the same box theory here. Here's resistance. And you can count 4 trigger lines past the area, right? So again, here's your resistance as a absolute area, and then you got 1, 2, 3, 4 triggers, and then that means, yes, you should do one more 5-1 trend trade. And then, same thing. We can use the same logic going forward. Let me see where we're at live. And again, I'll get back to theory in a second, but I want to do live and theory at the same time. Look, we have hit resistance. How many triggers do we have past the resistance? Count them. 0, right? Everybody can agree? There are 0 triggers past the resistance. Everybody agree with me? Just type a little Y in the room if you agree, because you have to be able to see it in real time. So before we ever take another long trade, right? So we can say to ourselves, fibs hit, no triggers beyond, no more long trades. Now, I'm not necessarily going to go short because it's a really strong market up, but it's very, very, very definitive. Agreed? 4 triggers are passed. Look, so when you go and you scroll back, you're like, okay, 4 triggers weren't passed, but we still went up from fibs. And then 4 triggers were passed, so we can do a 5-1 trend trade. We're on our way up to the area, so we can do another 5-1 trend trade. And now that we've reached the area, we need to see something very definitive, which is 4 triggers beyond the fib. Now, this is where the flexibility but the rigid rules come into play. So we need 4 triggers passed before we do another one. Now watch, I want to go back to the trading plan for a second. And again, the plan is pretty simple as far as the trigger lines go. But look, this is where the Milby, this is where automated trading systems fail time and time and time and time again, because they're going to take a trade even though they ran into fibs. So, but look, watch. This is one of the criteria that we use for stopping a 5-1 trend trade. So we get a very strong push through a blue Fibonacci area, right? And because we have a strong trigger push through a fib area, we're going to do one more short trade. And again, there's I call it pushing the bottom or pushing the top. That's kind of a good term, I guess, or a visual term. And what happens is you're essentially trying to trade a breakout of the fibs, right? So you're trying to trade this fib to break. And you can do it one time. But this is where automated systems fail miserably. This is where the new users of our software have a tendency to have their failures as well. When you push down after that first push, you can get one to work for you pretty easily. So again, you're going short right here and you're having a winner and you're like, yay, I'm going to take a winner and make my money. But what happens is you have a failure at the bottom. And it's during the failure to make new lows, failure to break fibs, meaning changing colors, some type of failure at the low all of a sudden and very instantly, I mean, I'm talking about like within 12 seconds, you go from being able to go short with reckless abandon and 100% happy, and the whole world is going for you, and you're making a ton of money, and everything is great. And then you have the same exact look, right? So, look, this one is the right one. And then you have the exact same look, and all of a sudden it's the wrong one. You know, I got to be careful with these things. They're hard to do. And the subtlety, you know, and again, this is very, very rigid rules, meaning if you do one but the fib doesn't change color, you don't do the second one. And the second one looks identical to the first one. Same fib, same triggers, same area, same everything looking beautiful. One of them will lose and one of them wins. So when I use terms like the gap between what you should do and shouldn't do has to be closed through practice and execution of a plan that is very rigid, very little ambiguity, but also is flexible enough to account for the dynamic nature of the markets. This is what I'm talking about. And look, Melby, and again, I know you did some work trying to do some automated systems, but the automated system at X sees the same thing that it sees at the check mark. One of them wins and then one of them gets pummeled. And it's the difference, you know, and again, when we go through our plan, look, the same thing here. Melby, if you don't mind, watch. I'm going to show you the exact same concept, but it's a little different, which again, this is the flexibility, but the rigidness in the thought process. Okay. So again, it starts with a transition trigger. Okay. So because the synthetic triggers are still up, we have to treat the market differently. Okay. You're going to do a trade. And again, look, you're going to do, let's just say this was your trend trade. And you're going to do that trend trade, you know, and again, it's probably more in this area right here, right? You're going to do a trend trade and you're going to do this trade and you're going to end up winning it. And then because of the failure on the smaller chart right here, or the support holding, even though up here it's going to look the exact same, it's going to lose. It's kind of a hard concept until you get it, and then you're like, oh, okay, I got it. So one, and then because you hit fibs that held during a transition, you have to stop doing short trades, trend trades on the 5-1 chart. Doesn't mean we won't ever go down again. It means that we'll probably go down from a much higher spot, you know. Maybe we do or maybe we don't, but this is where you start looking at a higher spot to go short, maybe something way up here versus a 5-1 mid band or a 5-1 trend trade, which ends up losing. And again, the trend trade itself is going to look identical to an automated system. It's going to have triggers down, transition down, but one of them is going to win and one of them is going to lose. So it's the same concept. Because you're not in a number one perfect and something is trying to break or something is amok, one works, one doesn't. And again, not that you'll never go down again. And we go back to Eddie's trade. You know, let me find Eddie's trade on here. Because again, it's a good example of the same thing. Because we didn't get 4 triggers passed and we were in a transition, right? Small triggers, and he even wrote transition. That gives, you know, when you're in a transition, the divergence on the small chart, you know, or a fib on the small chart, or a gap back to the synthetic triggers. There's a couple of things, right? there's a couple of things that when you're in a transition, as he even wrote, you have to pay more attention to. One of them is 4 triggers not getting passed. One of them is a gap. One of them is divergence on your small chart. You see where I'm going with this? So, the experienced users have all of these, there's about 6 things that can kill a trade. And it just so happens they're all labeled for you. So it's not like you have to come up with anything. You just have to get used to seeing, again, look, I'll go through the next one. Because look, the more you go through this, the easier the concept is. Milby, does this help start to clear it up a little bit? Again, this is a weak trigger line look. You watch the rigidness of it all. In the real world right now, we just talked about, bear with me. Look, remember we said Eddie was like, well, it's weak right here. Right? So a weak trigger look, but the idea is, can you take one more long with the weak trigger look? And when does a weak trigger look stop the market? Well, when you get to fibs. And then when is it okay to go long again? Well, it's okay to go long again when you get triggers past the fibs. So it's very definitive things that we look at. And again, until you kind of get them down, it takes a little practice. But look, same thing here. This is why I use this example, because this is a weakening trigger line look. And this is out of the plan again. But again, look, when does a weakening look actually stop you from taking a trade on the 5-1 chart? Well, when the 5-1 chart has fibs and divergence and all of the things. So, again, you may be taking trades. I mean, it's not the best look, of course, but you may be taking trades short. You may be taking trades short. And then all of a sudden, I mean, literally in an instant, just because you did this right here at a fib with a weak trigger, it's over. I mean, literally, no more shorts. Doesn't matter how far you've gone, what you've done, that's it. And this is the exact moment in time that this 5-1 trend trade becomes low probability. And again, it was the same thing over here because you had a weak trigger and a fib, and then it's okay after you break it to take another short. So again, Melby, I want to hear from you real quick. Does this concept, again, it's rigid because weak triggers, right? So look, weak triggers is a situation that the small charts will terminate 5-1 trend trades. Doesn't mean it'll never go down again. As a matter of fact, the next picture in the plan is when it's okay again. So take a look. This is the same picture here. Oops, hang on, bear with me. This is the next picture that's in the plan. And again, when does the weak trigger stop us here? And then look, the large chart says we're still going to go down. All the triggers are down. The trend is down. Everything's going to go down. But the 5-1 trend trade would lose, right? Here, let me go. This is the better. The 5-1 trend trade would lose after this situation. And then, but, this one will end up winning. And then this one will end up winning. So again, it's which one do you do and when do you do it based on the look? And then when do you stop doing trades, right? So you stop them after you hit here. And it's not that it'll never go down again. You understand? So it's just you're not going to do 5-1 trend trades because 5-1 trend trades don't work, but bigger pullbacks work. And because the fib didn't change color. And then when the fib does change color on the small chart, we can do trend trades on the small chart again. 5-1 trend trades. And again, this is where Again, you get this same situation. Let me show you in the live market, right? So in the live market right now, we've got a weakened trigger line look still. Now, usually, I mean, we keep going long until, but I think my charts may be a little bit off. But the idea is, look, if there's a smaller chart reason why the 5-1 trend trade's not going to work, right? So again, look, if weak, the small hold on, let me add to that real quick. How's that? Is that better? If the 14-2 triggers are weak, if we have divergence at fibs exactly like that, then no more 5-1 trend trades. What that means is that traditionally we're going to make a deeper, lower retracement. So again, everything is situational based on what the market is doing at that time. And again, I want to go back to the original thought. The gap between predicting something that will happen and thinking about all the money you could have made and the reality of getting in and out of trades or not doing trades is one of the most difficult things. So what we've done is we've spent 22, 23 years seeing patterns that traditionally will stop the market or lower probabilities. It's not perfect, but usually if you have weak triggers and you have fibs and divergence, the market has a tendency to make a deeper retracement before it goes down, which takes us back to what Eddie was doing this morning, which again, I don't mean to pick on Eddie, and Eddie's tough. Eddie knows better, but because of what happened over here on the big chart, should not be doing a 5-1 trend trade. And it's not that we won't go up, we're just going to go up from a deeper spot. And that's the flaw in his trade setup that he did. He did a 5-1 trend trade when he should have been looking for a deeper retracement. Do you guys understand that? And again, that's the difference. It's like it wasn't a number one trend trade long because you actually called it a transition. It was number one look. It wasn't because the synthetic triggers were still crossed down. Eddie, do you see that? So you wrote transition and then you wrote a number one trend trade, or no, trade number one. Sorry, my bad. I overread that. I'm done with yours. Anyway, and look, this is what the whole thing is about. It's which one should you do and which one should you not, and when should you wait for a deeper pullback and when should you not. And again, I think that's where our plan really excels is we've done a really, really good job over the years of first, and again, let me do this real quick. Bear with me 2 seconds here. My workspace was wrong. I'm going to clean out my data while I'm talking here. So bear with me 2 seconds. I'm going to reopen my workspace. Again, we've done a really good job, I think, of not only, recognizing the right spot, but number one, more important than anything else, is having the correct trigger line look. And again, the management and the entry execution and the when to stop taking a 5-1 trend trade are all the same. Because once you get this concept down, then everything becomes very easy. Look, I'm going to go to management of trades. Watch. The management of trades is the exact same thing, Milby. If you're in a transition, you're going to pay attention to smaller chart areas and divergences. And if the synthetic triggers don't come along for the ride in a transition, the small chart could make you stop doing 5-1 trend trades. If you're in a number one look, meaning all three trigger lines are going down and the smalls are below, you don't have to worry about the small charts terminating a trend or a trade. Does that make sense? And then if the triggers are in a weakening mode, meaning small triggers are inside, then you again have to pay attention to fibs and divergences and pivot stop outs and all the things on the smaller charts. So I think this is the magic picture. Not only it's the same thing. It's how are you going to manage the trade based on which of the three situations you're in on the 14-2 chart. Is that helpful from a just a standpoint of, just kind of being a little bit easier with things? Which position you're in, transition, number one, or weakening, is going to depend on, or tell you how much to pay attention to the smaller chart areas. So again, it's, the management entries are the same thing, but again, just these two pictures alone, I think really sum it up for you. If it's weak, well, you pay attention when there's smaller chart fibs and divergence. And not until, some will use that as a counter trend trade, which is okay. But it will also tell people that, we'll still go short because the trigger line read, but it's probably going to be from a higher area. So you'll get your more experienced traders going long here and making a bunch of money, and then going short here and making a bunch of money, and then they go short again on a pullback over here. And they end up with three trades. As a new user, you end up with 1-5-1 short trade that loses, and you're like, why did it lose? Because we were in a strong down market. And it's like, John T or Siva or Nick, or there's so many of them that have had software forever. They go long here, they go short here, they're doing more shorts over here, and they're up $1,000 a contract. And the new people are like, what the heck? Why am I not getting all that money? So again, Melby, hopefully, does this help a little bit? And again, when you see the things that will kill a trend trade and you really learn, I think the biggest thing is, what trigger line configuration is going to make you pay attention to the smaller charts more? When will you ignore it? When will you pay attention to it? That will really simplify what we do. So again, let me show you the live market. And again, you'll see how this plays out in the live market. Agreed that, again, when you go back and look at it now, you say, okay, we had a termination condition, right? But we're still going up. We just didn't do it from a 5-1 trend trade spot. And then because of the 14-2 chart having triggers past the fibs, we actually did do a 5-1 trend trade, and you won if you did it. And because you were weak, but you were not yet at the fibs, you were still able to do a 5-1 trend trade because you didn't come off of resistance on the small chart. And then now we have to still determine where we're at. So look, we're still in a weaker trigger line configuration. So this is where, look, I'll bring it back to show you. Melby, tell me if this is helpful for you. So look, this was our first weaker look, but we didn't really have any fibs to worry about. So this is where a lot of people still did one more long trade. Now, Eddie did it, got out a little early, which is fine, no big deal. And then we hit fibs, no triggers pass, so no long trades until it breaks. And then we go immediately into weak triggers. And now not only do we have weak triggers, but look, we have a small chart that stops us. You see what I'm saying? So we had the small chart, fibs and divergence, stop us from doing this trend trade, which is wrong. It's still a trend trade. It looks good, right? On the small chart. If you didn't have this fib up here and this divergence, you would for sure say this is a perfect trend trade long. Agreed? Some of you guys may have done it anyway just because the market is so strong. But this is the one that doesn't follow through. Melby, do you understand the concept? Again, weak triggers is okay on the 14-2 chart, but don't hit fibs. If you hit fibs, you got to wait. And look, this was a good trend, same trend trade long, but it was low probability. Right? It worked anyway. And this one is also a lower probability trend trade due to fibs and divergence on small charts and weak 14-2 triggers. And usually, again, look, sometimes they work, sometimes they don't. When they don't work, they usually don't work very quickly. And again, you may say to yourself, well, why would anybody take that trade? And the answer is, I don't know. They would take it because of an exclusion or an exception that they've put into their trading plan based on their experience that says, even if you hit fibs, take it anyway and manage it tightly. Because I've had software for 32 years, right? But, again, it's, I don't care about the one that you don't get. I would rather have you take, look, let's go back in history. I would rather have you take a trade from here if you were lucky enough to get it, a trade from here if you were, awake and trading after the triggers break past, right? So triggers break past on the big chart. That allows you to take one more trade and win. Everybody give me a Y if you understand it. And then we have a weaker look, but we don't really have fibs, so we do one more, and then you end up winning that one. And then we do have fibs, so again, buyer beware. The next trend trade actually wins, but who's going to do it into that fib? Nobody, most of the time. And then the same situation here. We have a weak 14-2 trigger. What kills it? Well, you just have to recognize it's lower probability because of what we were just talking about. Look how exactly similar this looks, when we go back to what we were just talking about in the rules. We were just talking about this exact same thing, right? Weakened triggers on the 14-2 chart, divergence and fibs on the small chart. It's not going down anymore. And in fact, some people will use this look on the small chart, large chart to go the other way. If you can't go short, why not go long? Well, here it is in the real world live. If you can't go short or long, can you go short? You guys tell me. I've seen it 100 million times, but again, I'm not the new person trying to learn how to trade it. So again, look, when to stop doing or when to recognize lower probability trend trades is key. You may or may not be a counter trend trader yet, which is fine. Does everybody understand this? Again, very, very, very important because, again, look, conceptually, when we talk about big difference between predicting something that will happen in the market and actually getting into or not getting into a trade. And the psychological gap of feeling comfortable with what you're doing is what we preach. And, when we talk about, you know, tracking your trades, right? And these steps to becoming proficient with our software, learning the rules, learning the trigger line and Fibonacci rules for when it's okay to take a trade or not okay to take a trade. That's number one. So just like what we were talking about, when can you take a trade? When can you not take a trade? And then when should you pay attention to the smaller charts? And when should you not pay attention to the smaller charts? Once you get that down, almost everything becomes very obvious and very simple. Everybody worries more about the rules when I say worry more about the look. What look are you in and what should you do with a given look? Go once, but watch out. Go for sure, don't worry about it, and then go once and watch out. Go for sure no matter what, and then go for sure, but watch out for whatever happens on the charts. Does that make sense? And again, you have to learn the look that you can or cannot do it. This is the magic right here because the fibs, I wrote this out last week. Let me see if I even have it. Nope, that's not it. Shoot, where did I put? But I mean, I wish I had it. I don't know where it is, but think about it. The dynamics of the fibs are created with 30 days worth of data. I mean, we're talking about, 30 days worth of data gave you this fib. You're not going to know it's going to hold until you're put in the situation, right? Was it going to be this one that holds, which was awesome, or this one that holds? And you don't know. You don't know for sure. So again, could you do a counter trend trade here and lose? Sure, you could. But again, we have rules against doing counter trend trades when we have 100 bars going to the upside. We wait for it to turn. Can you guys hear? Can you guys hear me okay? Somebody give me a Y in the room. Okay, just making sure. So again, when can you do it? When can you not do it? That's everything in life, guys, with what we do. And again, once you see it, it's obvious. Once you get it and you make the connection in your brain between, yes, I can do a 5-1 trend trade, or no, I can't. Once you get that connection in there, it really becomes easy. And again, look, the weakening trigger line look without reaching a fib doesn't terminate the trend. When it, again, this is why Milby automated systems stink. They don't have the dynamics of 32 days worth of fibs. You get 30 days worth of fibs and you end up with literally to the tick. I mean, that's about as to the tick as you can get of a reversal in the market. What do you think? I mean, you can't get much more precise than divergence at fibs right there, and that's the high. Could have been over here, but it didn't change the trend, right? It was a good, really good spot. But this was the one that actually dynamically said, hey, that's it. No more longs. It's amazing once you get it. And then the triggers, they're as dynamic as can be. They go up and down based on what's happening. So again, it's, not to preach too much about the thing, but think about it. It's how do you get better, right? And again, the the path to success, the plan, the difference between shoulda, coulda, woulda, and I actually did is practice and execution of a plan that's very rigid. So, Milby, you had this question, and this is basically for you, but for everybody, of course. Do you guys understand the idea of the plan is very rigid? If we're in a XYZ situation, we really pay attention to the small chart. Very little ambiguity. You don't do a 5-1 trend trade anymore if the small chart stops the market. But if the small chart doesn't actually stop the market, you can keep going. So again, when we talk about dynamic nature of the markets, look at it. The fibs didn't stop the market up here, so we did one more long over here. Many people did. And got away with it. The dynamics of the fibs right here said same situation, weak triggers, but because there was fibs and divergence, no more. And no more it was. Now, we have to go back, and again, don't ever lose sight of your big chart. So this is the same situation that we were talking about with Eddie earlier. Look, we now have a spot that potentially could cause a bounce. So again, look, let me do it this way, just for grins and giggles. This is what we call a termination of a 5-1 trend trade situation. If the mid-band and support holds in a transition that we don't want to do any more short trades, if you did a short trade. Not until we get a good breakthrough of this area are we going to worry about doing short trades. All right. Do you guys understand this concept right here? We have a transition look and the triggers are down strong, but we ran into some support. And when we run into support, especially, and a transition just means that your synthetic triggers are still crossed up. All right, that's all a transition look means, is that your small triggers are going down and everything is red and everything looks like we're falling out of bed, but the synthetic triggers are still up. The overall big trend is still up, right? So again, because the synthetic triggers are still up, we have to give a little bit more, credence to the mid-band as a support area. Now, that could give way and the triggers could change. And then, of course, we'll be with the market dynamically. If the market conditions change, then we'll obviously treat it differently. So again, Z, I understand what you're trying to do, trying to go long right here. But again, look at the trigger line configuration. This is not the best. Again, for us, I know what you're trying to do. You're trying to do a pivot stop out long from the midband. I understand that. Again, that's a more advanced type of trade. The problem with this, remember the picture that we saved last week? We were searching the internet and we said, what's one of the worst things that you can do with your money? Where was it? Was it Friday? I forget. Hang on. We go through so many of these pictures every day. It's just, anyway. Oh, I know where I put it. And I'm not disagreeing with your long, just from a trend trade perspective, it's obviously not what we're looking for. What did we do? Again, strong triggers. This was our visual representation of don't trade into strong triggers too much. Let's see if it comes out right. You don't have to trade. Man, that's really taking a long time. Do not trade into super strong trigger lines against you. It's one of the most dangerous trades you can do. I don't disagree with your trade or what you're attempting to do, right? You're attempting to buy a pivot stop out at a spot on the large chart that will cause a bounce to the upside. Z, you see what I'm saying? And again, the problem with going long is that these small triggers are so wide. And I know what you're doing, and you'll probably get away with it. But for the new user, transition look and the super wide triggers, it's like, it's hard concept to present to everybody, but it should be pretty easy. Everybody wants to be a hero at the top or bottom, and you don't have to be. If your small triggers are too strong, Jerry, you said it best, strong triggers break things. Can you say to yourself before you try to go long at 72 that these triggers are too strong for that? In my opinion, that's too strong of a look to try to go long and catch a pretend bottom. All right, you got 10 ticks plus one. All right. Do you guys understand the concept? When the small triggers are that wide down and the large triggers are that wide down, going long is horrifically difficult. We don't need it. You don't need that in your life, right? Now, look, our synthetic triggers are pinching and starting to cross over, and we're starting to build a better story, right? So watch. Let me clean out all this mess. I want you to think about something. Watch the visual difference here. And I don't know if it's going to hold or not, but look, we're going to talk about area 5492. Okay. Not aliens or anything crazy like that. Just fib area 5492. Fib area 5492. Stare at the triggers, not the fibs. Because you have to look at the fibs, but you really have to look at the triggers. Now, let's stare at area 5492 over here. Same fib, same area, different triggers. What do you think? Now, Eddie, this is exactly what you did in reverse this morning. Watch. Not 4 triggers past midband. No 5-1 trend trades. Doesn't mean we won't go down, but it's probably not going to be a 5-1 trend trade. Look, I'm going to go back to yours this morning. Same thing in reverse. You hit the mid band and it went a little bit past it, but not 4 triggers past, so no 5-1 trend trades. But doesn't mean we won't go up. You have the same thing in reverse right here. You see it? Not 4 triggers past and the small triggers are going down strong, but no 5-1 trend trades, but it doesn't mean we won't go down. We're probably going to end up going down from a little higher area, more than most likely. Eddie, and again, I don't mean to keep calling your name, but you had, you were nice enough to post in your loser, which I really appreciate, because when you guys post in a loser, everybody can post in a perfect trade that won. Raw, who cares? You're supposed to do that. Okay. And then look, I enjoy seeing your winners. It's okay. You're going to learn a lot more from posting in a loser than keeping it to yourself. Just that one post. I mean, how much mileage have we gotten on that one post? you know, I mean, that's a lot of mileage on one post. And I know you're probably done with it and don't want to hear it again, but again, it just bears repeating because everybody makes the same mistakes. And you get caught up in the heat of the moment and you're like, yay, 5-1 trend trade, everything's going up. And then you look back, and you're like, what the heck? And not only did you get stopped out on the low tick, you're probably so pissed off about getting stopped out on the low tick that you don't have the ability to get back in again and get the rest of it. Which is frustrating because you technically got stopped out one tick from the lowest low. You got stopped out at 76 and it went to 74. Which is frustrating because you had it dead to rights. You were just getting in on the small chart, not the big chart. Yeah. Potentially there's a plane that's about to come through your roof, Milby. So it's not going to happen, more than most likely. So I say that in jest because people always worry about divergence that's not gonna happen. So watch, and I say it jokingly. I'm setting you up for a joke. Watch this. On the software user guide, which again, a lot of people don't read the user guide, but when we look at the indicators, okay, and we look at T3 divergence and potential. So I'm doing this from the user guide. When we have potential divergence, what we're talking about is, and again, we used to use the MACDs a lot. In 2003, we were using a MACD indicator. Okay. And what we would do, Milby, is we're taking a live retracement percentage in price versus a live retracement percentage in the MACDs. And if there's a turn, meaning at least 2 bars down, then you'll end up with divergence. Potential divergence is just that. It's a live mismatch in the retracement percentage between the price swing and the MACD swing. It doesn't always materialize. And sometimes you can have potential divergence for 100 ticks all the way up or down. So we don't worry about potential divergence. But it does plot live on the bar potential divergence. So again, it's one of the situations where, if you're at the right fib and if you're with the right trigger line look and if you're under the right circumstances, if you have potential divergence, then you really need to make sure that you're managing a trade a little differently. Or if you're long and you have potential divergence and the background color is red and you have potential divergence, you need to have your stop over here, not down here. So we use potential divergence in management. And again, let me just show you in a live real world circumstance. So this is what Eddie was doing, and it's not wrong. Technically, for the circumstance, it was a little bit wrong, but what he was looking at was potential divergence on the way up with a red background. So it was plotting potential divergence. He was long, and there was a red background, and there was potential divergence plotting, so he took his money. So again, potential divergence is okay, to watch out for if you're in a trade and things are going against you. And then here's the dynamic part of it. Unless the market is so strong that the little chart should be ignored. I know it's kind of goofy, right? Because you're always saying, well, you do this, but you ignore it if that. Milby, that's what you're trying to get to, right? That's the hard part. Yes, you do it, but if XYZ, you don't do it. And if XYZ, you do it. And if XYZ, you don't do it. And if XYZ, you do this. If XYZ, you do that. I get it. That's what you're trying to get. So I'm trying to get you there as quickly as possible in one day. So again, this is where on the management side of things, if you have potential divergence and the background color is against you, then you're going to take, an exit if you run into something. Does that make sense? So potential divergence is used technically, but it's only used under certain circumstances. Let me see if I can. Let me see if I can find an instance. And again, there's another instance too, and this is in the management video. If you have a number one look, you ignore the first divergence and you ignore the second divergence on your charts. If you have a number one look, if you get a third divergence, which you have to recognize that potential of a third divergence on one chart happening before it happens, then you're going to be short, but you're going to get out after the second bar up, after a third divergence. So again, there's two situations where, if it's a number one look and you get a third divergence, you're going to get out. Or if you're headed in the wrong direction, let me see if I can find. Well, this is a good example too. Look, let's say you're short against the trend, but the trend is still technically green, right? So we do some counter trend trades, obviously, against the trend. But look, this is a situation. You see the potential divergence here, Melby? On the right edge of the chart. It's hard to see it. It's down here. If you're against the background color, but you're short and you have potential divergence and you're running into support, you should take your quicker money, not wait for bigger trades. So again, it's good to recognize, but you also don't worry about divergence, unless you're at a spot where you should be worrying about divergence. Does that make sense? So again, just like what we said, it's important to know where you're at on the 14-2 chart before anything else. And again, that's why I said, this is a good example of really strong trigger lines over here. And then the small chart killed us up here, killed the trend. And then now, it's like, if these synthetic triggers were all the way down here and crossed down, we would treat this area a lot differently. Because there's still a little bit of a gap, we may very well go up a little bit higher than just 92. We'll see. At least get to 92 is where we're headed. And this is what Z was trying to do. He was trying to buy this area to get back up here. Right, Z? Which is the right thought. Maybe just too strong of a condition to do it with. So again, everything we do, guys, very, very dynamic. Right? And again, we don't even have to do anything. All we have to do is know what to do under each situation. And again, these are detailed out for you in the trading plan. And this is why Paige, again, look, ultimately, our goal is to wait for a couple of high probability trades that don't have anything against us so we can make $400 a day. Everybody who trades high probability trades doesn't have, I've yet to have one person in 20 something years say, I trade the right fibs and the right triggers and the right looks, and I have trouble making money. It just doesn't happen. Now I have a lot of people who say I'm having trouble, but it all stems from the first thing, which is trading against strong triggers, which is not tracking your trades, which is doing the wrong things at the wrong times, and not trading things properly, not, taking an exit when they're supposed to take an exit. This is an example like what we were just talking about. If you were short and you hit blue fibs and you have potential divergence and the background color is green, Melby, just to kind of finish up that thought with the divergence. And again, this is where tracking all of your trades and your pictures becomes very handy because you have an arsenal to use. So in this situation, we were talking about managing out of our trade with a small win or at least reducing the risk. But again, do you see how obvious it is? Potential divergence circled, blue fib, green background, and we're short. Just take a small win or no loss, and it's better than holding on and hoping when the conditions are against you. And it really is. I know it's hard for somebody who's traded for years, who swings a very broad sword. Chris told me that you were used to dealing with like $300 stops trading futures, which gives me the heebie jeebies. We're down to like laser like, this is the one tick on the planet and the condition that will terminate the trend and make it go the other way. It's very precise. And again, the level of precision at which we've written the plan and the rules and some of the things takes a little while to get used to. So again, I tell people, don't get frustrated that you don't know everything that we know inside of a couple weeks. This is the path everybody takes. If you've traded for a long time, you're going to have an easier time with it. If you haven't ever traded before, it take a little longer. You're going to do a demo of our software, and you're going to make a determination of if our software and our education and the plan is worth the time and effort and money to continue learning. Everybody who's with us for any length of time says unequivocally the answer is yes. During the demo, you have to be able to see the benefit of the precision of what we do, so that way you can commit the money. Not only the money, but time, because it's going to take you probably, Melby, and I'll go to our conversation because you're right on track during your demo, is you're trying to figure out, what's my 1, 2, 3? What's my ABC? What trade is mine? What trigger line look is mine? What makes me most comfortable? And what's going to be my flow? So most people take probably 30 days after their demo to put together their plan or their flow, if that makes sense. Again, it's like for me, this is my flow, if you will, right here. And again, I'll give it to you. Look, this is the thought process for me. It's you're going to become a winner, or I'll use it in my tense. I will become a winner by taking the same looking trades every single time without fear of loss. And these are trend trades that I will take 100% of the time, no matter what. And my entry will be place a limit order at the fibs or mid bands if the 14-2 chart configuration is okay, if I didn't reach some type of termination spot, and if my 8-2 chart has a number one trigger line look. And blah, blah, blah. So look, this is what the trade that's a number one perfect trend trade looks like to me. It has the 14-2 triggers in a transition, which is rule number 1. Rule number 2 is that the 8-2 small triggers are physically below the large triggers going down on the 8-2 chart. So first I get this look, second I get this look, and then finally I can wait for the fib to fib oscillator to pull back and price to pull back to the triggers on the fib, at which point I will have a limit order waiting to go short at 58 or 59. And I would do this trade 1,000 times in a row without fear of loss. I would probably win 75% of them. I would lose 5 to 10 ticks on my loss, and I would make 20 to 30 ticks on my win. Does that make sense? But look, this is the process you have to get to, and it's going to probably take you a month, which, again, a month isn't that long. It's going to go by quick, of learning which look is yours, which trade is yours. Now, once you have determined these are my look or looks, you have to then do the hard work, which is to practice that look or those looks on simulator until you're 100% confident you're going to win. And this is why we've made this tracking sheet for you. So you can actually trade during the day on simulator and record your results and record pictures of your trades. And if you guys don't have this sheet, get it. Go file, download as, Microsoft Excel, unblock it, and make it yours. And then, again, just to kind of revamp this again, look, learn it, trade it during the day, simplify your trades, go back and retrade the day every day. So you sim during the day what you think is correct, and Sam, you just posted in, comment if your trade was okay. We'll look at it in 2 seconds. And then go back and do replay at the end of the day and fix any mistakes you made. And then once you're all done, take pictures and any rules or, little, any little rules that kind of popped up their head so you can get a visual of, okay, 3 divergences with a gap to the synthetic triggers ends the trend. Just whatever lessons of the day pop up. Now, if you're only looking at your little chart, you're thinking long, 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 stay long, and then after 3 divergences, you can't go long anymore. So you can do 5-1 trend trades up until the time you get your 3rd divergence. Milby, do you understand this? We just talked about it. You can do 5-1 trend trades until you get your 3rd divergence, and then you can't. You can go back and find this day, 7/29/2019, and from this spot, it went straight down. So again, it's learning the rules, but more importantly, practicing and applying the rules and doing it for, give me 90 to 100 days of trading during the day live, posting your pictures in class, and then replaying the day every day. And you're going to be so freaking confident that you're going to be able to go in and say, I guarantee myself my plan makes money every day. Then you can start trading live. So, for most people, this process is going to take 90 to 120 days. And man, look at that. We didn't quite get our 92, did we? That was really close, but I'm going to look at it. All right, Sam, let me take a look at your post. I appreciate you posting your picture. This is crude oil. And you went short at 79. I mean, we were talking about going short, but from a little bit of a higher area. Again, it's not a bad trade, I don't think, in any way, shape, or form. And again, look, what are your rules, and did you follow your rules? As far as a trend trade goes, yes, we were looking for more down. Didn't quite go as high as we wanted, but obviously the conditions were good for a short. Sam, right? Milby, sure, absolutely. I'll do a visual for you. I actually put a visual of your question in the trading plan. Check it out. It's on page 5. Watch. On the trading plan, page 5, because I get this question so much, I stuck it in here, okay? A 1-to-1, or we call them 1-to-1s. Okay, Melby, it's a Fibonacci alternate. And the measurement of the Fibonacci equal distance 100% projection, look, if you take the distance from the high up here at the fib and you go all the way down, and let's say that that's 50 ticks. And then the market makes a retracement, higher highs, higher lows, higher highs, higher lows, higher highs, and then finally starts making lower lows, meaning we resume the downtrend. The 1-to-1 dots, the yellow dots, are going to say, how far was my last downtrend? And then from the top of the beginning of the new downtrend, what's the same distance? So it's a 100% Fibonacci projection from the top of the retracement. Does that make sense, Melby? It's pretty easy once you see it, but again, for us, the 1-to-1s represent, again, there's been studies done on Fibonacci and stuff, but Elliott wave, people call this wave similarity. You'll see a lot of times like Apple stock will go up $20 and then everybody takes profit. And then it goes up $20 and everybody takes profit. And then it goes up $20 and everybody takes profit. So the thought is it's a psychological thing that, there's an emotional measurement of the market can only take so much going down before it goes back up again. And it only can take so much going down before it's going to go back up again. For us, more importantly, when these little yellow dots are at key areas, they help us to really fine tune that spot. Case in point, right now, these yellow dots, they could become a support area for us that could potentially make us go back up if the trigger lines were correct. So again, we have to kind of say to ourselves, what is the trigger line configuration on the 14-2 chart first? So again, look, Eddie wrote it out first, but I'll write it out again just to show you. Right? So the trigger line configuration first and foremost, which is rule number 1, is transition to the upside. And then we have weak triggers, small triggers, strong and weak combination, but ultimately stronger and inside, strong and then inside triggers, right? So we have a good trigger line configuration for long trades, long trade, and then ultimately we have, I'll just cheat, copy paste, transition triggers to the downside. Yeah, I know Carolyn, she's good at what she does, but she only uses fibs from a single perspective. She's a very flat use of fibs. She's good at what she does. I'm not saying she's bad in any way, not bad mouthing her, but she's only looking for a target projection area where we can use, because our fibs are automated, she can't possibly do what we do. And the reason I say that is because she's very specific about the couple of fib ratios that she uses in the swings that she does them from, which is not bad. I'm not saying it's bad, it's just different. We do things a little bit differently, right? We use, and I'll go back to a presentation I did, we measure all of the pivot points in the market, right? Lots of them. And we go in and we measure retracements and we measure projections to the downside. Like this is what we were just talking about right here. This is a projection, 100%. And again, the market doesn't always stop at 100%, but it bounces. And then ultimately, what we do is we take thousands and thousands and thousands of swings over the course of 30 days, and we do essentially every possible Fibonacci projection and retracement from every possible pivot point over 30 days. Then our software goes in and it creates, I did not mean for that to pop up. Our software creates 9 higher time frames and does every possible fib projection and calculation from 10 time frames. Then our software goes in and assigns, more importantly, a weighting hierarchy to each of the Fibonacci projections. Here, I'll take a little picture of this. We can just look at the picture. Hang on. I'll give you guys a picture of this because it's pretty cool. And again, this is what our software does. This is why the dynamics of it are ridiculous, as far as what it does. And again, I wrote it and it still amazes me sometimes. And again, the software itself does every possible pivot, but there's a weighting hierarchy. It's just like, let's say you're going to the bar and you're going to get into a bar fight, and you're basically sizing up the competition. And there's a little 120-pound man who's mad at you, and you're like, I'm not really worried. And then there's a 290-pound man, look like J.J. Watt, who's coming at you angry. You have to assign a weighting hierarchy to who you're going to run from the first. So fibs are the same thing. The bigger the ratio of a fib, the more potential turning power it has. And the higher the more exhaustive quality it has, if you will. And then there's also a hierarchy for time frames. A daily 786 retracement is going to have a lot more power than one little swing, a 1 minute 786 retracement. So again, what our software does is it combines all of the thousands of time frames and projections and fibs together, always stays current. Every 4 hours it updates, and it always does the same analysis the exact same way every single day. And because it does the same analysis the same way every day, it's very, very consistent. And again, it's never perfect. There's no such thing as perfect, but when you have the right conditions, such as weaker triggers, and then you add 2 weaker triggers, fibs and divergence, you all of a sudden say to yourself, wow, okay, we do have the ability to predict a top. And again, you may not trade short right there, but again, we were looking for some shorts right in this area. Didn't quite get it, but that's okay. There will always be more. And then remember what we said, we're at a weakening trigger and a bouncing spot. So again, when we put the whole party together, what you're going to see is, look, tell me if you see what I see. 165 EMA, 1-to-1s, yellow dots, which are 1-to-1s, and almost weakening triggers with a gap back to fibs and synthetic triggers. So we're starting to build, if you will, the potential of a story of this area for us. See how the small triggers are almost inside right there? See how they're starting to almost weaken? So we start to build a bit of a story for ourselves with the trigger starting to weaken, and then we go to our smaller chart and we're like, oh, okay, look, if we get fibs exactly and a pivot stop out at fibs and maybe even divergence, and we're talking about specifically from right there exactly, if we get all those things to come together, this might be enough to stop the market. So we may come down to here, let's say, and if we don't break that area, we could potentially go back up and retest some higher areas. Now, Melby, let me show you one more picture from that little thing. I didn't mean to close it out, but look. This is every support and resistance. If you were to actually take a picture of all of the raw data of all of the fibs and support and resistance for a given area, if it all carried the same significance, then they all break and they all hold. So look, this is the raw data, Milby, from a programming standpoint. So this is the right edge of an S&P chart a long time ago. It had no move on. So the idea for us, the simple idea, is that the weight of any one support or resistance can be determined through, where is it? Let me clean up my toys here. The weight of any one support or resistance can be determined by the trigger line configuration. Simply put, if the trigger line says it's going to break, it does most of the time. If the trigger line configuration says it's going to hold, it will hold most of the time. So every support and resistance can hold and every support and resistance can break. Our job is to define some type of probability of that actually happening. You understand what I'm saying, Melby? So just like when we took this look here, let me clean up for you real quick. The probability of area 5492 holding right here was very slim because of the strength of the triggers. You see that? So this area, because of the triggers, holds zero weight whatsoever. But the same area now, because the trigger line configuration is totally different, holds almost impeccable weight. If it gets there, you can almost guarantee yourself winning trade or a high probability trade. You see what I'm saying? It's the same fib, literally. That's the same fib right there at 93 as it is over here. The only difference is the situation that's created by the dynamics of the market, which is people saw value or stopped seeing value in crude oil up here and started selling. Just so happened it was that divergence in fibs on the small chart, which is fine. It's no big deal. Just means we're not going to get suckered into taking the next loser. So we can see it happening and unfolding. So now, if and when we get back to here, you can see how clearly the trigger lines support the idea of going short at that area. Maybe I say you can clearly see it. Let me ask the question, do you clearly see how if we retest that Fibonacci resistance, we'll have a better chance of it holding as resistance? Everything was going up here, all triggers going up. The fib won't hold. Now all the triggers are not going up if and when we get there. Melby, did that answer your question? The idea is, in this video, to understand, again, that's what this video goes through, is seeing the trigger lines and the fibs together. When the triggers are weak, the fib supports hold. When the triggers are down at a fib, the synthetic triggers, the fib area holds. So you can determine that this fib area with this down synthetic trigger is going to hold before it ever gets there, which is exactly what we have right now. We can already predict that this fib area up here is going to hold because of what the triggers are saying at that area before we even get there. Which means what? This is the target for your long trade. Everything is determined. Every support and resistance that we have, whether it's mid bands or fibs, can be determined by the trigger line configuration. So, Melby, look, you tell me what the triggers look like when we were at this green midband. See how it had no chance of holding? Because of the trigger line configuration. And the more the triggers got below the midband, the more likely the midband is going to break. You see what I'm saying? So right now, it's likely that the midband is probably going to hold and take us back down to where we, do you see what I'm saying? So look, green midband over here, very small chance of holding. Magenta midband over here, looking at our trigger lines, it's got a pretty darn good chance of holding. So look, these triggers support this midband making us go down. The answer is always the same. Fibs and triggers, fibs and triggers, fibs and triggers. Yes. Let me go to our YouTube page. I'll show you an older video, but I'll still leave this one on here. It's from like 3 or almost 4 years ago. But I have so many of these videos on YouTube. You can go back and look at them. But everything is about Fibonacci and trigger line reading, always and forever. Always has been, always will be. You have to know which ones you can use and which ones you can't, and why. That's always the case. So again, look, when I say this, now this may make more sense to you. Obviously, trigger line reading. When you go to the trading plan, or you go into even these videos, look, it's still the same thing. It's fib and trigger line reading. What are the trigger lines doing? And then what are the fibs doing around it? If the triggers are strong, the fibs break. If the triggers are strong, the fibs break. If the triggers start to get weak, fibs start to hold. And again, it's the same thing over and over and over. You can do it a million ways to Sunday. It doesn't matter. You just have to get used to fibs and trigger line reading, fibs and trigger line reading. And in the plan, if you really think about it, the 3 components of a trade: reading the triggers on the large chart, making sure that the trigger line configuration and the fibs don't ruin your trade, and then ultimately making sure that the fibs and triggers line up when you're placing a trade. So when you're going long, for instance, come on, dial up. Goodness. So when you're going long, you have the correct fibs on the small chart and trigger line configuration on all charts. So triggers right, Fibonacci works. Triggers are strong up, Fibonacci resistance will break. Gary K, this is your first trade. I like it. And, and again, this is okay. Again, almost a number one look. I can agree. And again, you don't know that there's going to be divergence, Gary, until after there was divergence. So again, there's probably, did you do market replay over the weekend, Gary? The trade technically is correct, but it looks like you kind of need a cleanup of your data because there's some discrepancies in here. But anyway, the answer is, for almost all intents and purposes, the answer is yes. Almost a number one look is close enough to be able to put a trade on. My fibs are a little differently laid out than yours, but that's okay. You may want to think about doing a clean out of your data over the weekend or after the day today. Let me give you a little thing. This is on page 5 again in the trading plan, just so you know where it is. I would suggest cleaning out your data when you're done today. Page 5 actually has a lot of the stuff we use every day. Make sure you've got current charts and templates from the website, how to delete your old stuff, if you've had software a long time, how to clean out your data. NinjaTrader is a very sensitive beast, and unfortunately, I can't control that. The only thing we can do is try to circumvent it. If you do market replay, a lot of market replay over the weekend, it's best to clean your data out every day. It just doesn't hurt. It only takes a minute. If your Ninja doesn't open, sometimes your workspace gets corrupted. Again, we have stuff in the user guide and hear about it. The other thing I always tell people, maximize your screen space. You don't really need to see 150 ticks above or below the market. Make sure you've got your screen space, to where you can see as much as you can possibly see. There's a little blog page with NinjaTrader that'll tell you when we're going to roll contracts. For example, around August 15th, which is later this week, we're going to start looking at rolling our August crude oil contract to the September contract. Or September to October, October to November. So we're in September now. We're going to roll to October, but you guys get the point. Again, this little calendar, which is also on page 5, will also help you, and then there's also on page 5 how to make a market analyzer. Some of you know this, some of you don't. But you can actually track the different crude oil months and how much volume there is in each one of the contracts. Because when we get to rollover days, we'd like to trade the new month that has more volume. You loaded up a bunch of replay? Yeah, maybe. Okay. Anyway, you don't need to delete your replay data. You need to delete your live tick data. Look, to do it, it's very simple. All you do is you go into your Documents folder, NinjaTrader 7, go into the database folder and you delete cache and tick. That's all you have to do really, is delete those two folders with Ninja closed. Here, I'll give you a picture of this just so you have it. So look. All right, so this is the quick, clean version right here, Gary. All right, now, again, look, 1-to-ones doing their thing, causing support. And again, I'd love to see us get back up to this 92 because this is the type of area where we'll end up seeing counter trend trades, edge trades, pivot stop out shorts. This is the type of area where we would see pivot stop out longs, and this is the type of area where we'd see pivot stop out shorts. So pretty easy, right? Look, at the edges, we'll do pivot stop out longs or shorts. And in the middle, with all the triggers going really strong, we'll try to do trend trades. Milby, no, the fibs are totally independent of the trigger lines. I wrote this out the other day, man. I wish I had it. Let me see if I have it. Shoot. Let me see if I can find it real quick. Because it was really good. And if not, I have to write it out again. Bear with me 2 seconds. Shoot. I just don't know where I stuck it. All right, I'll write it out again. It never hurts. Look. Fibonacci creates a 30-day structure that measures the emotional I have to say, Milby, and you may appreciate this, my freaking C6 and C7 in my vertebrae, my hands are numb and it's starting to get to be hard to type. I'm gonna have to go get a spinal freaking disc replacement here. So look, Fibonacci is a high-level 30-day structure that measures the emotional responses from each and every swing, from each and every time frame, giving us a big potential support and resistance. The trigger lines, think about it, the trigger lines are only a 20 bar, 38 bar, or 20 bar, let's call it moving average. Right? So, Fibonacci kind of sets a framework, if you will. And then the trigger lines, I mean, it's only a 20 bar moving average or a 38 bar moving average or a 20 bar from a bigger chart, synthetic triggers. So, again, the whole thought process is that we're, setting up an emotional structure of support and resistance. And then we use the trigger lines to determine when those are going to hold and break. And again, this is where, we go to this as kind of a simple version of the same thing. Look, if we get a fib support, we can say with pretty good confidence that if you reach support and the trigger doesn't break it, when we get a retest of the support, we can use this support as a counter trend type of signal because the triggers did not break it. Milby, do you understand this? And again, I put a little more detailed version of this inside of the trade tracking spreadsheet, but just real simply, this is real easy stuff. Fib gets hit, the triggers didn't break. On a retest, it's going to hold. Now, so that's our counter trend trade, pivot stop out, right? Everybody recognizes it. Now, when we get to a fib, if the triggers are strong, remember what we said, that if the triggers are really strong, we'll usually do one more trade. And then if the fibs don't break, we won't do a second trade. until the fib changes colors. Well, this is visually, you can see it. If the triggers are strong, we might take one more to get up to and through. And if it doesn't break and then the triggers physically get back below a fib, that fib generally on a retest or a pivot stop out will hold and go the other way. So Milby, again, just to slow this down to a real crawl here. Over here, you can be very assertive at that blue line to go long because of what happened over here. Over here, we have to be a little bit more reactionary and we have to wait because the triggers and the fibs don't quite jive. Now over here, if we got a signal, these fibs and triggers jive a little more for going down. And then ultimately, if we don't know for sure, once the triggers start going down strong, then we sell pullbacks. You know, this is where we do trend trades on a small chart. Then when we get to a fib, we evaluate our triggers. And remember what we always say, if the triggers are really strong through a fib, we're going to take one shot at going short. Look, remember, watch. This is the same look. If the triggers are really strong past a fib, we're going to take one shot at going short. But if the fibs don't change colors, we're not going to take a second shot. So if we get to a blue fib, it's okay to go short as long as the triggers are strong and a little bit through it. We're going to try to go short, hoping that it breaks. If it does break, then we're going to use that area again should the market get back up to it and the trigger lines don't break it. See it? So we'll get one shot over here and then it'll come down and then we'll get a second shot at it later. That's kind of where we're at in the live market. The triggers overran the fib over here, but now the synthetic triggers are much more favorable that this fib holds. So we had to wait until the triggers got below the fib before we could use it to go short. So watch the simplicity of it. Super strong triggers, take one shot. If it breaks, yay, you made a bunch of money and you can keep going short. If it doesn't break, then it's a one and done. And then if you're going down, obviously, and you get to a fib area, if the triggers get past it and fail to get back above it, we can assume that over here, our same rule, if 4 triggers get past a fib, this is only 2, but you can imagine 4, then we're going to take more short trades. And then if the triggers are really past and the fib changes colors, we'll keep going. I don't ever like to use the word always. The only thing that you can do is always do the same thing. So, again, look, pivot stop outs happen all the time. Okay, so again, just to kind of use it in the context of the trading plan, okay? Counter trend trades. Look, if the market has a range bound trigger or, the triggers are weak, but we never, ever, ever want to trend trade against a number one look. So Milby, think about this for a second, okay? In the trading plan, I'll have the plan up. So look, in the plan, remember what we talked about with the triggers? Hang on. If we're in a transition, maybe we get a pivot stop out on the small chart, and it doesn't necessarily mean go long, but it might mean stop going short. Pivot stop outs against a number one look never reverse the market, almost ever. And then pivot stop outs when the triggers start to weaken usually will reverse the market. So trigger line dependent again for pivot stop outs. So again, before we get into the rules, think about pivot stop outs. You have to have, watch, weakening triggers on the large chart before you can do a counter trend trade pivot stop out on the small chart. You see what I'm saying? So this pivot stop out long, which is right here, is dependent on this trigger being weak or, obviously something else. So all pivot stop outs will look the same. They're going to have divergence first. You're going to have a divergence line, which is magenta, and then you're going to retest that line for your entry. So think of it this way. And again, I always tell everybody master the trend trade first, but you're going to do them both, so you might as well work. So let's go with an assumption first, okay? Weak triggers on the 14-2 chart. So it is okay to counter. Okay? So number one, you're going to reach fibs and you're going to get a divergence. Again, this is all in the rules and the videos, but number one, reach fibs, have divergence, and then number two, you're going to place a limit order at the pink line. So your entry, literally look, if 14-2 chart okay, if pivot at fibs with divergence equals true, then place limit at magenta line. So you're literally when you're going to do a pivot stop out trade, you're going to place a limit order right there, which is going to only result in one of two things, Milby. You're either going to have caught the top and you're going to make a lot of money going short, or you're going to lose 10 ticks max. And you're only going to do it once. One and done on counter trend trades, because if you break fibs and triggers and divergences, then the trend resumes. So again, before a trade, and nothing sneaks up on us. Because look, we have to have this divergence first. So first we have this, and then eventually you're going to place a limit order right there. And you're going to hope for the best. You understand that, Melby? So assuming that the 14-2 chart agrees, you're going to place a limit at a prior divergence high or low. So when it's retesting the pivot stop out, you're getting short on the way up. So again, conceptually, what are we trying to do? Buy low, sell high. So because our fibs and divergences and triggers are precise enough, we usually are able to buy the low or sell the high. If we lose a little bit. If you win, look what you win. You win an enormous amount of money. And if you lose, you only lose a little bit. And then look, sometimes you get a pivot and you put your stop in and then you still lose anyway. But if you were to lose the trade at the bottom, let's say you were long right there and you lost, you'd only lose 4 or 5 ticks. So if you only lose 40 or 50 bucks, who gives a rat's ass? I dare them to try to come take it. Sometimes they do and sometimes they don't. It doesn't matter. As long as we have the right look at the right spot with the right condition, we have odds in our favor. Make sense? So again, odds are all defined. I mean, look, you've seen the common thread, right? Odds are defined by fibs and trigger line looks. When can you do it? When can you not do it? When can you do it? When can you not do it? When can you do it? When can you not do it? And it's all written out in the plan, but you have to get used to the idea of yes, you can, no, you can with the same look because of this. So hopefully this has been a helpful, little tutorial on, how you're going to take our trading plan. And again, it's not just the plan. And again, look, I want to go through and give you guys the path to success. The path to success is always the same. During your demo, you have to say, do we really know what we're talking about? And does the software with all the triggers going in your favor give you good trend trades, and that the edges of fibs with pivot stop outs give you counter trend trades? And if you pay attention, then it's obvious the only answer is yes. It for sure gives you the advantage to the nth degree. Now, just because you bought software that gives you the advantage, it's just like buying an elliptical or a Stairmaster or a stationary bike and some weights. If you just stare at it and throw it through the window, you're not going to get skinny, right? You have to get your ass up on the machine and ride the heck out of it and ride it for, 6 hours a week and lift weights for 6 hours a week. And then you're going to be all buffed up. Well, you're not going to make hundreds of thousands of dollars if you think you can get rich just from buying software. You have to get up on the software and ride it and use it and use it and use it. And it's going to take you probably 120 days at least. I always tell people, look, it's going to take you 6 months to be okay with our software. It's going to take you a year to get good, and it's going to take you 2 years to get great. But you can still make money in the meantime. So look, here's your pivot stop out, Milby. Damn it, I missed it. Shoot. Look, right there. I just missed it. We're talking. Look, pivot stop out of the fib. Live. Do you see it? I mean, right there, that's your long trade. I just missed the darn thing for talking. Do you see the pivot stop out? We had divergence. The triggers are okay on the big chart, I promise. And then this is the exact spot where we go long right here. And look, more than most likely, it's going to make it all the way back up to this green box, because we usually go from fibs all the way back up to other fibs. So if you were doing this trade correctly, per the rules, you would be in at exactly at this, somewhere between that line and this fib. I mean, sometimes they cheat a little bit and put it in between, but that's your window. It's a 3-tick window. I want you to see how specific this is. From 43 to 40. That's a 3-tick window, Milby. $30. And you should be long somewhere between 43 and 40. And now that we've had a pivot in place, your stop is at 38. So you should have no more than 5 ticks risk or $50 risk at this pivot stop out. And if it goes, again, some people do multiple contracts and they'll take half off here and then half off up here. Everybody does it a little bit differently, but the entry, and again, I want you to see it. And again, market dynamics, they're never perfect. There's always little subtleties, but look, when you look at this, again, you can kind of see the subtlety and the dynamics of the market in play here. So look, I want to take a full picture of it here. So bear with me 2 seconds. This is what I want from you guys when you guys post your trades in, the room, and when you guys save trades to your trading plan. I want you to do something like this. Look, three charts, because it's important to have all 3 charts. Because the first thing you're going to do is you're going to say 14.2 chart suggests, based on triggers, we can do pivot stop out long. Okay? And then you're going to say I had divergence, and then I got in at the fibs and divergence over here. Now, is it going to follow all the way through? We'll see. But again, remember, we just went through the rules for this. That's why I think it's pretty cool. The rules are get divergence first from a fib area, and then place a limit at the magenta line or the cyan line in the fibs. It's exactly the rules, perfectly. So when you guys are making pictures, I love this one to be in your trading plan. And then we'll see how far it goes. But look, if my calculations are I would imagine you're going to get 20 to 30 ticks out of it. 20 ticks from 43 to 63 is only right here. Right? 43 to 63 equals 20 ticks equals $200. And that's pretty much minimum what we play around with. Right? So that would just be getting to right there would give you $200. So we've already determined that we've only got what? We've only got 40 or 50 cents risk to make $200 minimum, maybe more. Right? Agreed? Now, how far will it go? We'll find out. Well, no, not at all. Because traditionally, when you get a pivot stop out and you've got, Eddie, what's called a gap to the synthetic triggers. So again, maybe it stops, maybe it doesn't, who knows. But what we'd like to see is for this area to get us back up to a divergence pivot stop out on the big chart. So look, before we even do anything, Milby, you can see the trade. Look, fibs, divergence, and then this, if we get back to 92, would be a pivot stop out at the edge of fibs. And again, it's just the same look. It's just on a 14-2 chart. So before we ever get back there, you can see if we do get a pivot stop out, we might have a really good resistance area up here. Maybe we do, maybe we don't. I don't know what happens. But can you see the pivot stop out before we even get over there? I mean, this could be an hour or two from now, but maybe you can start to see them ahead of time. And then you're like, wow, it's cool. With synthetic triggers coming down, it doesn't lower the probability. Now, if they were pounding right on top of it, Eddie, let's use it in reverse like this. If they were really pushing into it, then the answer would be absolutely not. So again, trigger line location key. Okay, let me expand on that for just a second. Trying to think of how you can look at it, but again, I think you'll be able to see the thought process. Look here. This is just from the trading plan. This is a pivot stop out on the big chart. And the synthetic triggers suggest the pivot stop out's going to work because they're far away. You see that? The farther away the synthetic triggers are on the big chart, the more likely that pivot stop out is to work almost every time. It doesn't always work, but the idea is that you're going to get back to the synthetic triggers from the pivot stop out. Everybody okay with that? And again, look, Melby, same look, divergences, pivot stop out, and technically this stop should be lower. And it creates a very teeny tiny little risk. And look, if it loses, this one lost. Look, if it loses, watch. Because you're in from right here, almost every time it loses, it does what? It breaks the fib, and then you can do what's called the apology short. This is why when we do counter trend trades, we don't try to do them 2 or 3 or 4 times because we're so close to the edge that if we break it or we lose, that it usually is going to continue to the next fib area plus, right? So we're expecting to get down to here now. And again, this is where I said some people will trade multiple contracts, right? And they'll take some of them off because, again, you can see that, we ran into some type of trouble up here, or maybe some people get to break even. And then again, very clearly, very small risk, and maybe you get to here and you go to break even. What did you guys end up doing? Selvin, you got in at 44. What did you do? Did you get break even with it, or? Again, if it goes all the way, it's awesome. And if it loses, even if you left your stop down here, you only lose a few ticks. And then what happens is you end up with this. You end up with, what they call the apology trade. I don't have an ATM set up, but usually you get what's called the apology trade. And they'll come back up here and they'll give you your trend trade, which even if you lost a couple of ticks or broke even, then you end up making 20 more ticks this way. I don't have an ATM in there. You see what I'm saying? So we lost, or maybe we didn't lose, but whatever. And now look, triggers on the large chart. I'm going to clean everything up here, guys. Do the triggers say we can go short? Yes or no? Quickly. Yes or no? Yes, 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 yes. Cool. So where's our short from? Our short's from mid bands and fibs. Agreed? I know you got to be quick, but all right. And again, look, this is where you guys need to take pictures. Take pictures of your trades when you get into them. I'm going to try to do this really quick, guys. It's hard to trade and teach and talk and all that at the same time. But again, I want you to capture the moment. What are your triggers doing? And then where's the area? I mean, we could go a few ticks higher, up to maybe 41 or 42. And then look, write it out and just say, number one, triggers on the 14-2 chart. This is why you should trade first and annotate later. But I want you to trade first, annotate later. 14-2 triggers on the 14-2 chart. Pull back to 54.40, which is probably the right spot. I might be in a little bit early, right? So again, look, you can see the spot, right? Triggers, fibs, mid bands. This is the spot to go short. It might go to 44, 45, but that's okay. And room 20 ticks to Fibonacci. Fibonacci support, right? Milby, do you understand all this? We'll get to gaps in a minute. Again, look, counter trend trade, you might have managed out of it, and then trend trade short because fibs broke, triggers are down, everything says it's okay. Again, this is why counter trend trades for us, look, if you get run over really quickly, you're like, it's not much fun. But look, counter trend trade from right there. And if it breaks, we end up with trend trade short. And again, we try not to dictate to the market, right? We let the market dictate what's going to happen. So, yeah, probably could have gotten a tick or two better, but whatever. As long as it goes down to the fib, then we're going to be okay. Or as long as it doesn't change colors or stop me out. So again, I have a picture to describe gaps. Milby. Again, gaps for us are fine, but think of a gap to a trigger as a potential tension in the market. Let's see if I can find that picture. Trying to find a picture for you. Look, think of a picture of a gap like this, Milby. The gap is your slingshot proper. The market is trying to pull away from triggers that are trying to go the other way, creating a tension. If where your hand is at fibs and pivot stop outs, then traditionally that fib and pivot. So I'm trying to put it in terms of fibs and triggers here. Watch. Think of it this way. These are your synthetic triggers. Oops, sorry. Come on. I always like visual representations. Okay. So the market's trying to run away from your triggers. If you have fibs and support and pivot stop outs, if you have fibs and reasons here, now sometimes if you keep pulling hard enough, it's going to break. Do you guys understand this? Again, if it's a strong trending market or something like that, you don't get this tension. Oh, look at that. We're starting to go down anyway. So again, we don't always get everything perfect the way we want it, obviously. All right, we're at the do or die zone right here. Alec, you took 10 and you're break even, all right? And again, do you guys understand that? I mean, we haven't done a lot of trades today. We're doing a lot of theory, but this is a trade setup that was for sure. Obviously, you could manage right here with a red background and divergence and the midband and triggers. We've got divergence here. What do the triggers tell me about getting out of my position? Think about it. I was getting into my position when the triggers were going up. So would you agree this is the same fib area? Again, I try to tell people not to panic in a trade. Look, we're getting in when the triggers are going up into that area. Now we're at the same area and all the triggers are down. Yeah, it's not necessarily a panic situation. If the background color changed to green, we'd be out of our position. If the triggers were changing, we could get out of our position. Alec, you went 10 plus break even. So look, this is a situation where our background color has changed, right? This is where we may say to ourselves, look, with the background color changing, we don't want to take a full risk or a full loser on this trade. And, you may decide to manage out of your position. Market flow, say get out. Yeah, I'm not doing real good on the management here, guys. You can see there's some things I could have done a lot better, but I'm not worried about it necessarily. And again, here's the problem. If you get out of your position, technically this is the worst place on the planet to put a stop, because this is still a situation to go short. Look at it from this perspective. Again, this is where I let the small chart bother me a little bit. When the large chart, give me the look of my triggers here, guys. What's the look of the triggers? Is it a number one look? And I'm not saying do it or don't do it, but I'm talking about management of trades or entries to trades and where you put your stops and things of that nature. A lot of it is dictated by what the trigger lines will do. My wife, when she'll put a trade on, she'll leave her stop up here and say, I don't care about anything that happens in between as long as it looks like this. Triggers. Watch. This is why I loaded this template for you guys. And again, I'm not saying go short again. I'm just, shoot. I didn't mean to do that one. Hang on. Let me try it again. This is why I gave you guys the 14-2 trigger line only template. So you guys can go in when you're in a trade or looking at trades or doing testing, and you can say, do you have the proper, without the mess of all the other charts, do you have the proper trigger line configuration? And again, we talked about this, a number one trigger line configuration. Traditionally, you don't let little charts take you out of your trade because it traditionally is going to make it to the fib. You guys see what I'm saying? And I'm not saying be in or be out. I'm not saying do a trade. I'm just saying the look of the triggers suggests we're going to make it to the fib. Now, you can't see the fib here because I just got rid of it, but where was the fib? Right here about. So again, a lot of people will let the large chart or little chart scare them out when they shouldn't. 19 is the fib. Okay. Again, Melby, this is a good finish to the trigger line thought process. See the triggers here? Instead of, where we got in and risking 8 ticks, we might have risked 10 or 12 to give it that extra little, oomph. So we can hang in there for our 20 ticks. Again, that's just regular use stuff. How many times does this trigger line go to the fib and how many times does it not? That's the key. And again, I'm not saying, look, my job is not to tell you what trades to do or not. My job is to teach you the trades and teach you how to read the triggers so you can go in and do your trades and put them in your trading plan and say, these are what I'm going to do. This is how I'm going to manage. If you need tech support, you can get with tech support. Obviously I can't do tech support, but this is what you should probably do, Robert. Do a little clean out right there. And again, I don't know. I've done so much stuff today to tweak my charts and change my charts. I don't want you to worry about trying to copy me or match me because I got a lot of mess going on here today. I'm trying to do some different lessons and do it a little bit differently today. I'm trying to really focus in on conceptual lessons of the day. Right? That's a good concept of the gap. The idea of, documenting, again, should I have gotten in a little bit better? Should I have really put my stop where I put it? These are all things that you can debate after the trades are over. When to manage trades, when to stop doing trend trades based on the large chart, small chart combination. Hopefully that's your biggest takeaway today. When to do a small chart trade and then when to stop doing a small chart trade. That was really my biggest intention for you guys for the day on the lessons. Because once you get this thought process down, these are all pictures from the trading plan. When can you do it? When should you stop it? That's the magic right there. Once you get that down, you're like, oh, it's obvious. So it just takes a little bit. I don't know what you've done, Robert. You could have put the wrong template on your chart. You can always reapply your 14-2 chart template. I don't know what you've done or what you've got. So there's two things you can do, and I'll show you where they are in the trading plan. go to the website and re-download charts and templates to make sure you haven't broken something. Delete your old stuff and redo it. And here's how you do it. And then clean out your data so you're starting clean. And then once you've done these two things, if we don't match up, then we can talk. Before you do these two things, and I've done it myself, then there's nothing to talk about. So that's all tech support's going to tell you to do or do for you. Well, when you say the second live trade, so look, here was the first trade. And again, look, this is where we were talking about conditional awareness, guys. If you're in a second trade and your background color turns green, then you're not going to allow the second trade to lose. You mean on yours, not today? Okay, I'm sorry, Kurt. You confused me. All right, this is not from today, or this is today. I don't know. I'm a little confused. Okay, so you entered at the mid band, you pulled your stop down to 2 ticks because of divergence. All right. Again, look, that's your management. And again, I think with a number one look, for me, preferentially, I'd have a little bit of a bigger stop with the number one look, Kurt. And then I would allow conditional based things to take me out like this versus just getting myself out. Because look, if you get out right there and it goes straight down, you're going to be like, why did I get out? All my indicators were not supportive of actually getting out. Everything that you did over here was even better over here, indicator wise. So again, I understand why you got out, but I don't think it makes sense. I think having a stop out of the way is a better idea with the number one look. And then eventually you do one trade, and then here it said get out for sure. So either way. Yeah. I mean, that's the whole thing is, again, look, I'll go to the plan. It never hurts to go to the trading plan. But look, I want you to see something. This is the old picture. It's from like 2016, I think. But, again, look, this is where, watch, let me take a snapshot out of here just so you can see, okay? Right here is where I'm talking about. I'll put a bunch of arrows on it. And I'm talking about, again, this is the one that I'm talking about. If you're in a strong trending market or a number one look, and the small triggers roll down after your entry, don't get out on an up bar or get nervous because traditionally it's going to keep going down. So in this situation, as you said, it paid off, but traditionally when the triggers roll down after you get in up here on the way up, once they roll in your favor, then it's just gravy usually. So again, your picture is you got out, but I just wanted you to see what it looks like when you got out. It's really a better look for hanging in there, and usually you get the money. This is the 1 out of 10 times it didn't work. You see that? Anyway, I appreciate you posting in the picture. It does definitely help. All right, so first things first, look, I want to talk about the 14-2 chart because if you always go back to it, it will help you out. Does the 14-2 chart support Oops, sorry guys. I accidentally sat on my mute button. Sorry guys. My question was, can we do a trend trade long right here? Sorry about that. Can you hear me? It was a trick question. High probability. And the answer is unequivocally no, because high probability trend trades, the small triggers must be physically below all the others, and then you got it easy. Or the small triggers must be above all the others, and then you have it easy. So right here, what do we have? We have small triggers, but they're below everything. Now that could change in time, but for the moment, we don't have long trades. So this is where we like to see Mother Scratcher come back. Shoot. Come on back. This is where traditionally we like to see another short trade if we get it. Now, we may not get it, but traditionally the 14-2 chart, look, if we had fibs and stuff right here, we would be thinking pivot stop out short to get down to here. We don't really have fibs, so you can't really do much with it, but so we have to do one of two things. Wait for the 14-2 chart area to break, which I'm not so sure about. We'll see. Or remember that little one-to-one trick? Anyway, I'm not going to do any cheating on it today. We have some work to do before we can convincingly say we have a bottom in place. Now, before it ever happens, look, you can start to see the potential, can't you? Divergence close to the fib. We go back up. We should probably come back down again. This is where we have our pivot stop out at fibs of a divergence line. And then we'll end up doing something like this. Turn that into a circle. So look, trend trade short on the big chart. All right. All right. But do you see what you're Alec, you're saying you went long on the small chart, but the large chart doesn't support a long. I understand what you did, and you're taking a chance from right here, which is fun. Right? And again, I don't want to confuse new people. Yes, this is a trend trade, but it's not a high probability trend trade. Right? So this is not a high probability trend trade due to these synthetic triggers and the location of our small triggers. Alec. And again, look, I'm not saying that you can't necessarily do lower probability trades. You can. But this is something for new people that you don't normally do. You don't get the chance to cheat the rules until you really have a super firm grasp of the rules and when you can cheat. There's always going to be opportunities to cheat the rules, but you really have to get good at high probability trades first. Does that make sense? Your objective is to make money first because your spouse or your significant other hates day trading and hates your guts for day trading because you've lost so much money and spent countless years on it. So it's imperative that you only do high probability trades and you relax and wait for the most consistent ones. and you make a little bit of money so you can get back on the path of heading in a positive direction. And then once you have 6 or 8 months of making real money under your belt, you can start doing the fancy trades. So again, just to recap, we want to make sure that you've got the correct, for high probability 5-1 trend trades. We want to make sure, number one, that we have the correct 14-2 trigger line look. We want to make sure that we don't have a configuration that hurts our 5-1 trend trade. Not saying that it won't go from a higher or lower spot, but from the 5-1 trend trade, these things will terminate it. And then ultimately, we're going to use the smaller charts, 5-1 and 8-2, to determine, how deep of a retracement we're going to get before we go long. And again, this is, trigger line reading. Small triggers are strong above on the 8-2. We get shallow retracements on the 5-1. If the triggers get inside or below on the 8-2, we make deeper pullbacks. Again, same concept again. If we have the 14-2 chart triggers agreeing, the 8-2 chart triggers agreeing, we can buy Fibonacci support and we can make some money most of the time. All right, questions. Milby, I know you said you had questions. Now's a perfect time. Let's go through any questions that you have. Again, hopefully this has been pretty insightful. The idea is to have the right fibs and the right triggers and the right looks, to stop trading when you have the wrong look, and to repeat process as many times as you possibly can until you get very good at it. All right, Milby, on the 5-1 chart, let me get rid of everything on here. All right, you're talking about these right here. So these are all moving averages. So what this is, you're talking about these dotted lines right here, right? This is the mid band from an 8-2 chart and a 5-1 chart. So the dotted lines are the mid band of an 8-2 chart. Okay. You're going to have to give me a picture then. Oh, you're talking about the small magenta dots? I'm trying to figure out where you're looking at. I'm just looking at my chart here. Take a picture real quick. Just draw a little arrow. Do you know how to do that? The yellow dots, obviously we discussed that as 1-to-1s. The solid white lines. You're talking about these right here? Okay, I get it. Sorry. I caught it back up. You're talking about all these lines right here. Those are the solid white lines you're talking about, right? First. This is the 14-2 reversal bar marker. So the solid white lines, now obviously these are the synthetic triggers. I'm trying to figure out which one you're trying to tell me. This is the synthetic trigger. Bear with me. I'll do it piece by piece so it can be clear. This is the synthetic trigger. Okay. Same triggers on the 14-2 chart, same trigger that's on the 8-2 chart. You okay with that? Oh, cool. You got a picture. I love it. I love pictures. Makes my life so much easier. Okay. This is the price at which the 14-2 will make an up bar or a down bar. So look, let me show you on the 14-2 chart. 2 seconds. 14-2 triggers only. So right now, the 14.2 chart is making up bars. The price at which the 14.2 chart will make a down bar is 54.39. Okay, Melby? So pretty much, for all intents and purposes, we want to trend trade when we're making up bars on the big chart. So as long as we're not making down bars, we'll look to go long. Short version, okay? So again, just tell me if you get this. This is the price of new down bar. Pretty easy. So we superimpose the price of a new down bar on the 5-1 chart. Well, now you can't see it, but that's your white line right there. So this is a historical, so it goes up every 2 ticks. So when the 14.2 bar reversal bar marker goes up, this one goes up as well. It's not a trailing stop. It's not magic. It's not anything. All it is the price of a new down bar on the chart. And the only difference on the 5-1 chart is that we actually plot all of them. So look, you can show all reversals in history if you want. And that's what you're seeing on the 5-1 chart. Oh man, did I just close my chart out? Hang on, sorry about that. Let me try that again. Now the other one that you're pointing to in your chart is what I told you it was. It was the that is the mid band from the 8-2 chart. So the little purple dots right there, that's the mid band calculation from the 8-2 chart, and then the dashed lines are the mid band from the large chart. And the reason that we use those, it goes way, 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 way back to like 2004. The mid bands from the larger chart are the first target for a counter trend trade. So all we're doing is superimposing a different mid band on the smaller chart, Milby. So the big dashed one is the 14.2 mid band. So if you were long, that would be the first target. And then the 8.2 mid band is there to help out. And then this is the 14.2 reversal bar marker price. You okay with all that? And again, now we're moving into a better look for trend trade longs. See how we're starting to move into a transition look? So we get one and done on some long trades. All right. Other questions? Anything you guys want to go through? I'm more than happy to keep going if you need it. Again, we went through a lot of information today. The biggest takeaway that I want is that it's imperative that your trigger line configuration agree with the trade you're going to do. If the trigger line configuration disagrees and the areas disagree, you end up doing losing trades. If the areas that the fibs and triggers agree, you do winning trades more often than not. And that's the magic. When to trade, when not to trade. When to trade, when not to trade. And again, vice versa, over and over and over. When to trade, breaking through an area, when to stop trading it. And again, the losers are going to look just like the winners on the small chart. So it's the combination of the large chart, the medium chart, and the small chart, all coinciding together that gives us our best look. And that's really, if I can leave you with one thought, is the idea of actually having all of your charts agree with each other at the same time at the same spot. So you can have the 14.2 triggers agree, the 8.2 triggers agree with the fibs and the areas, And when they all line up, you usually end up with high probability trades. Milby, is that a question or a statement? The 14-2 chart, do we have a transition look? It's either a yes or no question. If the answer is yes, then you have the right setup on your small chart. Well, if you have a red background, then what that means is that your small triggers are physically below the large triggers. That's what creates the red background, Moby. So if you're doing trend trades, you want it to be green on all three charts. How's that? Is that easier? If you're doing high probability trend trades, it's going to be red on all three charts or green on all three charts. So if you have a red background on the 14-2, but you have green backgrounds on your small charts, that's the look where you're going to do counter trend trades. Hang on. So you just nailed the secret right there. That's when you're going to do edge trades, meaning you have a downtrend on the big chart, but you have green on the small chart, so you do pivot stop outs, shorts. Make sense? I want to make sure that makes sense to you. That's an ideal situation, you know. Again, I think I have one of those in here, but that's an ideal situation where you have I don't know if this does it exactly, but yeah, this doesn't have it exactly. But essentially, you get a large chart that's down and a small chart that agrees. You know, it's green when you're going short, but that's okay. You know, you can go short when it's green on the smaller charts as long as your large chart agrees with it. That's kind of like what Eddie had this morning. You know what I mean? The large chart agreed with long. So if you had a pivot stop out in this area, it would be a really good trade to take. We didn't, but you know, again, that's okay. But conceptually, the same thing. You can't do the 5-1 trade because of the large chart, but you could do an edge trade because of the large chart. Milby, the NASDAQ is for gamblers and action junkies. Here's the question. I'm just going to tell you the answer and you can take it for what it's worth. Your objective, assuming that we're all on the same boat together, is to make at least $400 a day. You can do that without looking at an action junkie market like the NASDAQ that's very volatile. Crude oil and the S&P will get you to your objectives every day with the highest volume, which means the better fills, which means less slippage and slower moving, so you can really focus on what you're doing. My contention to you is that you only need crude oil to reach at least 400 a day, if not better, most days. My contention to you also, again, you know, it's different, but you know, the older we get, the less we're able to give a ultra high level of focus onto multiple charts. So think about all the different things that we talked about today and the ability to be ultra proficient and ultra good and really, 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 really top notch on one market with all those little things. To be able to get it down perfectly on one market, then you're making money. Then you can say, let me try to add a second market to eliminate boredom. I'm not against other markets, right? I mean, if you want to day trade Bitcoin, knock yourself out. But in the end, the highest liquidity markets, S&P and crude oil, or where you need to keep your focus until you become ultra proficient. Once you become ultra proficient, then you can take those crazy money making skills and you can take them to any market that you wish. So stay away from the NASDAQ for now. How's that?